Breaking tonight, Beijing and Washington just flipped the tone, and the world's supply chain is holding its breath. Multiple Chinese and American sources say Beijing is preparing to announce a suspension of trade with the United States unless tariffs and tech controls are rolled back. Reuters, citing insiders at China's Ministry of Commerce, reports Beijing is weighing retaliatory steps up to a full halt in US-China trade if Washington won't guarantee relief on tariffs and rare earth export restrictions. Major Chinese ports and logistics operators have been told to stand by, prepared to shift from slow-roll operations into a full trade freeze if talks fail. Last year, two-way trade topped $600 billion. By October this year, after the latest US tariffs, shipments had already fallen by nearly one-third. Chinese think tanks put exports to the US down roughly 27% year-over-year. Metallurgy and electronics are off more than 40%. State media insists domestic production and Asia-focused trade will cover the gap, but unofficial indicators say otherwise. The Shanghai Institute of Maritime Logistics estimates September container volumes fell over 18%, while idle terminal capacity hit highs not seen since 2020. For Shanghai, Ningbo, and Shenzhen, that means billions in lost revenue, softer freight rates, and heavier debt loads across transport firms. Washington's early October measures zeroed in on microelectronics, batteries, EV components, and rare earths, framed as national security safeguards and a push to cut tech dependence on China. Beijing calls it economic coercion. In response, authorities have drawn up their own curbs on critical minerals and are openly modeling a harsher option: a temporary halt in trade with the US. A source close to China's policy apparatus says if conditions don't stabilize by year-end, China reserves the right to stop all shipments to the US, including energy and industrial inputs. The pain would be mutual. American multinationals built supply chains around Chinese factories for decades. Unwinding them is costly and slow. Apple, Tesla, General Electric, and others are already asking suppliers about shifting capacity to India, Mexico, and Vietnam, but the bill will land on consumers. If tariff escalation continues, analysts warn US consumer electronics could run 12 to 15% higher, with appliances and autos up to 20%. China, meanwhile, would be forced to redirect massive output to its home market and Southeast Asia, creating oversupply and price pressure. Shipping lines are already blinking. Carriers such as Costco and Evergreen are cutting sailings to Los Angeles and Long Beach, reporting cargo volumes down 25% from last year. Bloomberg notes Chinese shipments to the US have fallen to 6-year lows by October, with trans-Pacific freight rates nearly halved, triggering ripple effects from port revenues to marine insurers. Inside the policy world, the consensus is shifting. This is no longer a conventional tariff skirmish. It's a long-horizon struggle over who controls the next generation of global markets. Beijing is betting on domestic demand and fast-tracked high-tech, chips, batteries, solar, while Washington tries to squeeze China out of critical component supply chains. In that context, a trade suspension isn't just bluster, it's leverage. Analysts at the Beijing Institute of International Economic Studies argue China wins only by refusing to play under imposed rules and say discussions over partial export halts have already reached Politburo levels. US reaction is split. Some doubt Beijing would go nuclear on trade. Others note that China typically preps public opinion and infrastructure first, then moves in phases. Reinforcing that view, reports of reduced purchases of U.S. soybeans and corn and pauses on several joint research projects in energy and aerospace. State outlets have avoided an explicit threat, but the rhetoric is hardening, accusing Washington of unfair moves and asserting China's right to a symmetrical response. Treasury officials are gaming worst-case scenarios. If Beijing temporarily suspends trade, U.S. GDP losses could reach 0.50 or 8% as early as Q1 next year, with raw materials, electronics, and consumer goods rising in price and fresh supply chain shocks for autos and tech. Beijing appears to be hardening for a long game. The South China Morning Post reports intensified domestic resilience efforts. State firms must lift local content shares for components to 85%, while private manufacturers get tax breaks to move capacity inland. Simultaneously, China is holding quiet talks with BRICS partners on alternative logistics routes and non-dollar payment rails, preludes to an architecture that steadily reduces U.S. centrality in China's trade. Markets are hypersensitive to every signal. A single hint in Chinese state media moves risk assets. Traders pass leaks for timing and scope. Officials on both sides are avoiding direct declarations, but more analysts now think Beijing is preparing a move that could redefine global trade. The open question is scale: a formal announcement of suspended trade with the U.S., or calibrated, symbolic measures that preserve maneuvering room. Much depends on Washington, whether the White House opens a negotiation lane or doubles down on pressure. Either way, the old playbook is gone. The U.S. and China aren't snapping back to the pre-tariff era. Economics, politics, and geopolitics are now fused, and each decision in Beijing or Washington can tilt the balance of power. The next headline could be a turning point for ports, prices, and policy from Long Beach to Shenzhen.